Dear professional students, we are still under derivative valuation and analysis. Now, we want to look at interest rate option as one of the derivative contracts. What is an interest rate option? An interest rate option is a financial derivative that allows the holder to benefit from changes in interest rates. I repeat again, an interest rate option is a financial derivative that allows the holder to benefit from changes in interest rate. Investor can speculate on the direction of interest rate with interest rate options. It is similar to equity options and can either be put or a call. Interest rate options are contracts on the rate of bonds like US Treasury security. Let me add this. Interest rate options is a right obtained by the holder to pay a fixed interest rate and receive unknown interest rate. Is an option or is a right obtained by the holder to pay a fixed interest rate and receive unknown, or let me say to pay a known rate rather. Let me make it that way. So the same language will be on the same format. Is an agreement or is a right for the holder to pay a known rate and receive unknown rate. That is a interest rate option. Now, known rate is what is the strike price, which is X, or known rate is the stock price. Understand? Fine. There are two types of interest rate options we have. We have interest rate call and interest rate put, which you can call interest rate cap. This is for call. And we have interest rate put or floor. Let me put here interest rate floor, which is for put. Now, let's look at each of these individually. When we are talking of interest rate cap is a derivative in which the buyer receives payments at the end of the period in which the interest exceeds the agreed strike price. You can see that it is like call. We said the buyer receives the interest rate that exceeds the agreed strike price. So the interest rate, we call it the ST minus exercise rate, X. So what is received is higher than what is paid. An example of a cap would be an agreement to receive a payment for each month labor rate exceeds 2.5%. So they are almost frequently taking out the period of 2 to 5 years. And this can be very considerable since the strike price reflects the maximum interest rate payable by the purchaser of the cap. It is frequently a whole number integer. For example, it could be 5% or 7%. By comparison, the underlying index for a cap is frequently a labor rate or a notional interest rate. Now, what we are seeing in excess is this. What I'm trying to say in essence, or what we use interest rate cap for. Interest rate cap is a class of option that we use to manage our exposure, and it is generally used by the borrower of fund. So when a borrower of fund borrow in the floating rate and he want to peg the amount of interest rate to be paid every year or every interval that interest due, he can use interest rate cap. So interest rate cap is a series of calls or is a series of interest rate call options that are bought in order to manage the payment of certain loan or payment of certain variable rate loan or floating rate loan. What will happen is that the borrower will make sure each couplet is equal to or is made to correspond to the each time is paid, and he will now agree to collect unknown rate and pay a known rate. Understand? And mathematical representation we are saying here is that there will be notional principal, which will show the maximum. This is a general formula for call option. Maximum of L minus K. Which one is it L minus K that is 0 or not? Where N is the notional value. Understand? And we also have the day count here. This half N is the notional value. The alpha is the day count. And we have L to be unknown rate. L is what? Unknown rate. And K is the known rate, which is known as a strike rate. That was what I said. Interest rate cap or interest rate call is an agreement or is a right to receive unknown rate and pay a known rate. If that is the case, the interest rate cap is also or could be analyzed as the series of an interest rate call. So that series of interest rate call that you use to manage your borrowing, each of these call is what is known as caplet, which exists for each period the cap agreement is in existence. Now, to exercise a cap, the purchaser generally does not have to notify the seller because the cap will exercise automatically if the interest rate exceeds the strike rate. Note that this is automatically exercised feature is what is different from most other type of options we have. Each caplet is settled in cash at the end of each period with which it relates. Let me further explain if you don't understand this. Let's assume you borrow loan for 6 years and you have to pay 12 interest rate. That is, if it is by annual or semi-annual, the loan that covers 6 years will require 12 interest rate payment. Understand? So for you to manage this rate, you have to buy 12 caplet. Now let's assume that you borrow at anyway it is floating rate. You don't know how much the rate will be. It is the floating market, and you know that for your company you can be able to do with, let's assume 5% on every interval when, or let me say 50% on every interval when the interest rate will have to be paid. Your cash flow can manage that. This is what you now go to the seller of the cap that you want to be paying 50% every quarter and receive what the rate at that quarter will be. So, it's an option. If the rate in that quarter is greater than 50%, you will exercise your caplet. So, you just collect the rate and pay to the borrower like that. But in this type of situation, is a kind of a cash settled. Let's assume the rate is 17%. What difference between 15 and 17? 2. The seller of the cap will give you 2% to add to the 15 you can pay in your company and settle your borrower, the financial house that borrowed the money. Ordinarily, what's supposed to be is that you will pay, remember we said you pay a known rate, which is 15% that you have agreed, which is strike price, and collect unknown rate, which is the rate at the quarter, or the rate that the interest rate happen to be at the interval you want to pay the interest to the company where you borrow, or to the finance house where you borrow the money. So you will receive 70% and you pay 12%. But in this type of business, you can do nothing. What is the difference between the two? That is, within these two, is the 2% that be. The cap seller will give you 2%. You add it to the 15% that you know you can confidently pay, and you go and settle that rate for that time. So in any period, when the floating rate is less than 15, let's assume 13%, you will allow this interest rate option to expire without being exercised. No, you are not under obligation. It is right. Remember, you are the holder. You have the right. You let it expire, and you just pay 13% to your lender. That is how we use interest rate cap to manage borrowing in the floating market. I think you understand all my grammar regarding that. Now, let's assume, let me just give you this example. Suppose that in January 2007, let me clean the board so I can be able to put down certain things for you to have as an example. The illustration says, suppose in January 2007, now and you hold a calculate on 6-month US Libor with an expiry of 1st February 2007, struck at 2.5. He said it struck at what? As 2.5. What this is saying that you want to be receiving 2.5 on the notional principal of $1. Understand? So if the Libor rate happen to be 3%, you are less bothered. If the Libor rate is 3%, what you will do is that you will collect, you will pay 2%, 2.5% and collect 3%. And let's use this model first. Remember, I said the formula is what? Is notional principal into day in question multiplied by maximum of L minus K. Understand? But notional principal is 1 million. Multiplied by how many days do we have? From January to February. From January to what? To February. You have how many days? So they can't fraction. What is the fraction? From January to December, you know, it is 6 months. Sorry, it's not January to December count. It is 6 months. It counts to 6 months of a year. That is 6 over 12. If it is annually, it is one that will be here. So 6 months over 12, that is 0.5. Multiply by what is the rate you agree to pay, that is K, and what is rate it happens to be, what line Libor happen to be. I said is what is 3. So 3 minus 2.5, everything in percentage. So we have 1 million multiplied by 0.5 into 0.03 minus 0.025. So what we have here is 2,500 naira, or whatever denomination it is. Let me read the question again so you can get the question done. I said, suppose that in January 2007, now, and you own a calculate of 6 month US dollar rate. 6 months US dollar, no, 6 months of the year is 0.5. That is where we get these are 0.5 from. So you don't get unnecessarily confused. So you struck a deal at 2.5% with notional of 1 million naira or dollars, and if by February the rate set at 3%, and remember that I said capulet or interest rate call is when you receive unknown and pay a known. At that time, you will receive 3% and pay 2%. So the difference between the two is 0.05 multiplied by 0.5 multiplied by notional principal. So that is what gives you 2,500. That is how it operates. And remember, like I said, it is used by what? By who? By the borrower of fund in order to manage the floating interest rate loans. That's on the cap. The second type of interest rate option we have, as I told you earlier, is interest rate floor or interest rate put. See, before I go further, when we are talking about call, understand, series of call is called cap. One cap is called caplet. Now, when we are talking of put, series of put is called floor. Series of floor is called floorlet. I think I've clarified that area. Now, when I'm talking of interest rate floor, is an opposite or the mirror image of interest rate cap. Interest rate floor is a series of European put option or floorlets on a specified reference rate, usually LIBOR. The buyer of the floor receives money if the maturity of any of the floorlet, the reference rate is below the agreed strike rate. Now, let's look at it in this perspective so you can get it clearer than this. Remember, under call put option, we said the value of put option is what? Strike rate minus exercise rate. The same thing for the floor or for the floorlet is that when the owner of the floor, we agree to accept, or we have the right to accept a known rate and pay unknown rate. I said you receive known rate and pay unknown rate. And this concept, interest rate floor, it is used by the lender to manage the interest rate, floating rate interest rate loan given out to borrower. As a lender, you give out loan. You know, according to your own financial statement, that if you can be able to receive certain rates at every interval, your cash flow will not be suffering or will not suffer. So is that rate that will go to the market and buy, and we call that one a known rate, and you will be ready to pay on known rate. And anytime the known rate is higher than the unknown rate, you make money. Understand? When the known rate is higher than the unknown rate, you make money. So the strike price is the known rate here. Unknown rate is the reference rate, which could be LIBOR or whatever. Anytime the known rate is higher than unknown rate, you make money. But if at any point in time the known rate is below the unknown rate, you will not exercise your what? You will not exercise your right. You let it go on exercise, and you go out there to go and settle your, or to receive whatever your lender is bringing. That is how it works. We have other, anyway, the model for that is also like that of a floorlet. That is the notional principal into what? Day count in fraction into maximum of exercise rate minus exercise rate minus unknown rate. It is like that. Now, we have interest rate collar and reverse collar. We are talking of interest rate collar. An interest rate collar is the simultaneous purchase of the interest rate cap and sets of interest rate floor. That's a collar. As you are buying, you purchase interest rate cap, and you sold interest rate floor. This is how the notation will be for the same maturity and notional principal amount. So the cap rate, the condition is that the cap rate is set above the floor rate. The cap rate, which is this, is set above the floor rate, and the objective of the buyer of the call is to protect against rising interest rate, one agreeing to give up some benefit from the lower interest rate. More so, the purchaser of the car protects against the rising interest rate, while sales of the floor generate minimum income or premium income. And a collar creates a band within which the buyer's effective interest rate fluctuates. That is a interest rate collar. We have reverse collar. When I'm talking of reverse collar, a reverse interest rate collar is the simultaneous purchase of interest rate floor. No, the other side. Simultaneous selling interest rate put. When you sell interest rate call, that will be you sell interest rate call ST minus X, and you buy interest rate put. So I said when you purchase interest rate floor, you purchase the floor. Floor is like this, X minus ST, and when you sold cap, that is ST minus X. Now, the objective is to protect the bank from failing interest rate. So, the buyer selects the index rate and matches the maturity and notional principal amount for the floor and cap. So, the buyer can construct zero cost reverse collar when it is possible. Look at it, please. A zero cost reverse collar, it is when it is possible to find the floor and cap rate with the same premium that provide the acceptable band. That is on the collar and on the collar, which could be reverse or the straight collar.